We all know that mutual fund investments are subject to market risks. Let's understand the concept of market risk and how to manage it. Let's take the example of an investor who invested in an equity mutual fund. And if he loses the money because the market goes down, that's market risk. But can we measure the risk? Let's check the journey of Sensex to understand the market risk in a better manner. Had someone invested for a 1-year period, he would have lost 14 times out of 44 observations. The risk is very high. But here is the game changer. When you invest for 5 years, you would have lost only 2 out of 39 periods. Or even better, for 15 years, you would not have incurred a loss out of all 30 periods. Your investment horizon and market risk are inversely related. It's like a seesaw. When one goes up, another goes down. So remember, the longer you invest, the more you can ride out market ups and downs. Invest for the long haul and reduce market risk. Mutual fund investments are subject to market risk. Read all scheme-related documents carefully.